Is it possible that Crocs basically sandbagged their guidance for the third quarter on really legitimate fears that tariffs were going to take a bite out of the company's not only demand, but also margins? And some of those fears actually haven't turned out to be reality. So that means that the company may beat earnings estimates for the third quarter and the rest of 2025. And they may be buying back stock at an attractive price. That's what I'm going to dig into today. I think this could be a stock that explodes by the end of 2025 if things turn out to be a little bit better than management guided for just a few months ago. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with that guidance because it was not good. This is in the second quarter earnings report, their guidance for Q3 and full year 2025. They're expecting revenue to be down 9 to 11% in the third quarter. They also pulled their full year 2025 guidance. So basically they said, hey, we have so much uncertainty in the business for demand, for what our costs are going to be for importing products, especially into the US. We're just going to pull our full year guidance. We'll give you an idea of what the third quarter is going to look like, but things aren't looking good right now. The reaction from the market was really swift. This is the year-to-date chart, but you can see right here, the stock fell almost 30% immediately after earnings. So there you have huge impact. Shares have recovered just a little bit, but not a whole lot over the past few months. But are things going to be as bad as expected? One of the things that I looked at is the trends for searching for Crocs over time. So let's just go to over the past 12 months. You can see there was a peak here in July and August. That has been down a little bit, but remember, we're moving into the fall months. So not as much demand in that period of time. Where you're typically going to see a pickup in demand is right around Christmas time. And then you have kind of a decline early in the year. So this doesn't seem like there's a huge drop off from seasonally where Crocs demand for search volume would be. Does that indicate that maybe we have a little bit more steady as it goes results than management was guiding for? Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Remember, the story here for Crocs is pretty simple. The company's revenue in the Crocs side of the business is growing steadily, 3% versus a year ago. So not a huge growth company, but it is a steady growth company and really good gross margins. So really good operating income and profitability. This adjusted operating margin, this is what was expected to be down in the third quarter based on those guidance numbers. But again, if we don't see the same decline in revenue that they were expecting and margins are better as well, that could leave a lot of upside for the stock. The Hey Dude brand down 4% versus a year ago. That's where if there's any sort of positive result in Hey Dude, that could lead to a huge jump in the stock. And that brings us to where Crocs may be spending its money if results are better than they expected a few months ago. Now remember, Crocs is paying down debt, where you're seeing that here is in the purple column. So they're paying down debt. Most of that is related to the Hey Dude acquisition. So not looking past the fact that that has been a disastrous acquisition, but they are reducing the leverage that's on the balance sheet. Their free cash flow is also increasing over time. Took a little bit of a hit in the most recent quarter, but you're also seeing the valuation of the company really decline pretty precipitously. The price to free cash flow is just 6.1 right now. So if they continue to generate $750 to $1 billion worth of free cash flow, what are they going to do with that cash? They're going to either continue to pay down debt or they're going to be buying back stock at this low price that we have today. I think it's very possible that the fear that management had in August, when it looked like tariffs were going to be on the rise, it looked like consumers were going to reduce their spending. I think some of those things have kind of subsided. Consumers are maybe not spending as much as they once were. But are we going to see a 10-15% decline in sales for Crocs? Are retailers continually putting off purchases? If we don't have that worst case scenario, there's a lot of upside for Crocs because even flat results for the third quarter and expectations of flat results for the fourth quarter could mean that this is a very undervalued stock and that management is returning cash to shareholders at a really rapid rate and a very attractive price. So add all this up, and I think there could be good news ahead for Crocs. But let me know what you think about the future of the company. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.